Hi, this is problem number 1, end of chapter 7 of your textbook. So this is a country where they produce only 3 items. They produce ice cream, and they produce shampoo, and they produce peanut butter. So in this 3 good economy, in year 1, in this country with just 3 goods, they produce in year 1 they produce 3 quarts of ice cream, 1 bottle of shampoo, and 3 jars of peanuts. And in year 2 they produce, and the output makes 5 quarts of ice cream, 2 bottles of shampoo, and 2 jars of peanut butter. So those are that is the output in year 1 and year 2. And the price is 4 per quarts of ice cream, $4 per quart of ice cream, $3 per bottle of shampoo, and price is $2 per jar of peanut butter. And this price remains the same in year 1, year 2. So only output changes. Now we want to find out the value of the output in year 2 in this economy with 3 goods. So first row, this row is quarts of ice cream. Every quart of ice cream is $4, and they produce 3 units of those. So 3 times 4 is 12. See? And then the next row is bottles of shampoo. In year 1, price is $3 per bottle of shampoo, and they produce 1 unit. So 1 times 3 is 3 value, right? And then jars of peanut, price is $2, and they produce 3 jars. So 3 times 2 is 6. So this column is giving us the value of output of each commodity, and then we add them together. So this is total value of output. This is nominal GDP of the country in year 1. See? And now we go to find out value of the output produced in year 2. We know the price is the same. Look at that, price in year 1, price in year 2 same. But whatever, this is the output of year 2. So 5 quarts of ice cream produced in year 2, and price of every quart is $4. So 4 times 5 is 20. That is the value of the ice cream produced. Then value of the shampoo produced, they produce 2 bottles, and every bottle price is $3. So the value is $6. Similarly, jars of peanut, 2 jars of peanuts produced, and at a price of $2 per jar of peanut, value is what? Value of 2 jars of peanut is 4. So you add all of them together, 20 plus 6 plus 4, and get 30. So this 30 will be the GDP of the country in year 2, and which is higher than the GDP of the country in year 1, which was $21 only. This is end of chapter 7, and problem number 2. And here they say that for a country we have personal consumption expenditure in a year is 50 billion, and then purchase of stocks and bonds 30 billion. Net exports is minus 10 billion, right? Minus 10 net export means what? There is a trade deficit in this country. Here export less than import by $10 billion. Then we have government purchase for the year 20 billion, and then sale of second-hand items 8 billion, and last is gross investment $25 billion. Now we have to find out GDP for the country. We know that 2 items will not be included in GDP. One is the purchase of stocks and bonds, 30 billion. This is not part of GDP. And the sales of the second-hand item, 8 billion, not part of GDP. So we will use now the so personal consumption expenditure is 50 billion. Purchase of stocks and bonds will be excluded. So, and then we include government purchase 20 billion, and then we include net exports minus 10 billion, and gross investment 25 billion. So we add those 4 items, add the 4 items together, and dropping the two other items, we get what? We get the GDP of the country is 85 billion. So this is the answer for this question. And the next question, question number 3, is telling us, assume the grower of a flower bulb sells, so they produce flower bulbs, and to do that they have to buy sells its annual output of bulbs to an internet retailer for $70,000. So the internet retailer is buying flower bulbs from the producer $70,000, and then the retailer, it brings $160,000 from selling bulbs directly to final consumers. So this final sale to final consumers, this 160,000 will be included in GDP of the country. The cost of the bulb, $70,000. This is paid by the internet retailer to the grower of flower bulbs, and that will not be included as in GDP, because that $70,000 is the intermediate value of the intermediate good that the internet retailer uses to generate this $160,000 sales to final customers. So when we calculate GDP, we will ignore 70,000 and just take the value 160,000. This 160,000 already include the value of the intermediate good, that is $70,000 worth of flower bulb. So we just take $160,000 and use that as to calculate GDP. This is end of chapter problem for chapter 7. This is problem number 5, and here they give us a list of items or of a country, and they ask us to find GDP, NDP, and then national income. So let us start. So these are the items, and then part A, we want to find out GDP in the expenditure approach. So for this, we know that GDP in expenditure approach is the sum of 4 components. One is the personal consumption expenditure, which is 219.1 in this example, and then net private domestic investment is 52.1, and we have to add consumption of fixed capital, which is 11.8, right? So these two items together, gross domestic investment. And then the third item in GDP in expenditure approach is the government expenditure, which is 59.4, government purchase. And then net export is what? Is we know net export is the difference between export and import, which is 17.8 minus 16.5. So together, so when we add all of those together, we have GDP for the country is 343.7 and billions of dollars, right? All of these are in billions of dollars. So part A answer is this expenditure approach. We add the 4 items, right? Okay. Now the next part is part B. We have to find out net domestic product. We know that net domestic product will be GDP minus consumption of fixed capital, which is depreciation. So net domestic product tells us what is the size of the output of the economy once we account for capital consumption of fixed capital or depreciation. So when we account for that, net domestic product now becomes 331.9, part B. What about part C? Part C is national income. National income is net domestic product, and then we have to make several adjustments. One is that we have to add net foreign factor income, which is 2.2, minus statistical discrepancy, which is 0. So if you go to the table, you'll find that this is the value. Statistical discrepancy is 0, this one, and then net foreign factor income here is 2.2. So when we make those calculations, national income is 334.1 billion for this country. So this one 334.1 billion. So this is the answer for question number 5. Now let us go to the question number 7. Here we have in column 1 we have year, and column 2 we have nominal GDP, and then in column 3 we have the price level. See, and base year price is 2005 base year, and we have to calculate real GDP from GDP. We can go to the slides and do the textbook and see that when we have nominal GDP and price index, we can easily find out real GDP by dividing this for every year. In every row, divide the nominal GDP with the corresponding price index and multiply with 100, and that will give us real GDP for that year. So this is what they are doing here. Look at that real GDP for 1968. We have nominal GDP 909.8 divided by 22.01, and all of this you can multiply with 100. So that will make calculation easier. So real GDP for that year, when base year price is 2005, will be 4,133.53. And now real GDP for 1978, you can take the nominal GDP for that year from the table, which is 2,293. Divide that with 40.40 and then multiply with 1, and this will give you 5,677.72. So and then let us go to the last one. Real GDP for 2008, nominal GDP is 14,441.4, and then price index is 108.48. so if we divide and then multiply with 100, it will be what? It will be 13,312.50. Now one thing we need to tell you is that the way they use this formula is they divide the price index with 100 first, and then whatever they have, so divide the price index with 100 and then divide the nominal income with that price index expressed in hundreds, right? So you get the same answer if you divide 909 with 22.01 first and then multiply the result with 100. So you can check